a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about ETFs that have outsized exposure to Tesla. So we know that October was a great month for stocks. The S&P 500 jumped about 7% in October, and that was thanks mainly to better than expected earnings. And this was the best October in 6 years. Now, two of the largest companies, Apple and Amazon, they were down slightly last week because when they reported, they mentioned how supply chain disruptions are affecting their operations. But in general, all other tech earnings were great, other earnings were great, and that is why stocks kept their upward rise last week too. But the biggest story last week was Tesla. Tesla joined the $1 trillion market capitalization club. It is an exclusive club. Microsoft, which is now the largest company in the world, beating Apple. So Microsoft, Apple, Amazon, and Google, these are the current members of the club. Facebook, which has changed its name to Meta Platforms. This was in the club earlier, but we know that Facebook shares have come down after some explosive revelations by a former employee. So Facebook is out of that $1 trillion club. Now, looking at Tesla, Tesla shares jumped more than 12% last Monday when it was reported that Hertz is buying more than 100,000 Tesla Model 3 sedans to add to its fleet. Now, shares are down slightly today when Elon Musk, the CEO and the richest person in the world now, he tweeted that Tesla has not yet signed a deal with Hertz. And Elon Musk has also said that for Tesla, it's not a demand problem, it's mainly a supply problem. And Tesla had delivered a total of 241,000 vehicles in the latest quarter. So 100,000 is a big order, but as I mentioned, according to Musk, it's not a demand problem for them. It's a supply problem. And Musk has talked about his ambition to make the EV electric car available to masses. And currently, it has a starting price of around 45,000. So it is more like an affluent car only for the affluent. But due to the partnership with Hertz, even masses can access the car, and if they like the car, maybe they can buy the car. And Musk has also talked about producing a 25,000 EV in a few years. Now, Tesla is very different from other members in the $1 trillion capitalization club. Companies like Microsoft and Apple, Google, they have very solid balance sheets with stable cash flows. We know that Tesla turned profitable only a few quarters back. It has a junk bond rating as of now. It is expected to earn $6 billion next year, which is a fifth of Amazon and about a 20th of Apple. Currently, the stock is trading at 204 times forward earnings, which is like some would call nosebleed valuation. But Tesla is a very innovative company, and millennials in particular, they believe in Musk and they believe in Tesla because it is an electric car company, and they are concerned about climate change. Now, interestingly, Tesla was not a part of ESG ETFs earlier, but they made certain changes in their sustainability, particularly their governance and social metrics, and that is why they are now included in most ESG ETFs. And we know that ESG ETFs have been getting a lot of inflows over the past few years. Now let's take a look at 3 ETFs that have outsized exposure to Tesla and have benefited from their Tesla exposure. So the first one I'm highlighting is a new ETF. It is not even a year old, and this has most exposure to Tesla of all ETFs. This is Simplify Volt Robocar Disruption and Tech ETF, ticker symbol VCAR. And as the name suggests, it holds autonomous driving companies. It is actively managed and may also use options to enhance leverage. It is slightly pricey with the 95 basis points expense ratio and is quite small, just 2.8 million in assets. And so in case you decide to invest in this ETF, please use the limit order. Now to learn more about this ETF, you can go to the code page on Zacks.com, and from there, using the link, you can go to Simplify's webpage to learn more about this ETF. And you will see, if you look at the holdings, Tesla has more than 20% weighting as of now. Other well-known companies like TSM, Nvidia, Microsoft, Netflix, Google, they are also there. Now, the second one that I'm highlighting is a very popular ETF with more than 20 billion in assets and very cheap too, 12 basis points. So it holds the consumer discretionary stocks in the S&P 500 index. The ticker symbol is XLY. So according to GICS sector methodology, Tesla is a consumer discretionary company. It's not a technology company, though we all know that it is more like a technology company. So to learn more about this ETF, you can go to the code page on Zacks.com. You can read our research report articles, and using the link, you can go to State Street Spider webpage for this ETF and look at holdings and other details. You will see that Tesla, oh wow, it has more than almost 22% weight because of this insane price surge. And then Amazon, Home Depot, McDonald's, Nike, and Lowe's. The third one I'm highlighting is by ARK. So we know that Cathie Wood is a big believer in Tesla. ARK's aggressive price targets on Tesla a few years back made ARK quite famous, and those price targets have been exceeding now, so she proved herself to be right. Her ETFs ARKK and ARKQ hold Tesla, and ARKQ, as the name suggests, holds autonomous tech and robotics companies. It is actively managed, 75 basis points in expense ratio, and because Cathie is so popular, the ETF has 2.6 billion in assets. And again, to learn more, you can go to the code page, and from there, the external home page, and you can look at their methodology, etc. Tesla, as I mentioned, is currently the top holding with about 13% weight, and you can look at other holdings too. And on the last slide, I have the comparative performance versus the S&P 500 index, and this is since VCAR's inception in December of 2020. So you will see that Tesla is up more than 80% during this period. The Volt ETF, Simplify Volt ETF, the new one, it is up more than 35%. The Consumer Discretionary Spider Fund is up more than 30%. ARK, the S&P 500 index is up more than 25%, and ARKQ is actually the worst performer of the lot. It is up about 15%, and that is mainly because of some other high beta companies that had surged in 2020. They suffered this year, so that affected the performance of ARKQ. KQ. In full disclosure, I own XLY in the ETF investor portfolio that I manage. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer, and also make sure to subscribe to our videos, our video channel, so that you do not miss anything. And I will see you next week.